The Mortgage Market Review, MMR, set out the case for reforming the mortgage market to ensure it's sustainable and works better for consumers. The FCA's view is that it had become clear by the height of the market in 2007 that while the mortgage market had worked well for many people, it had been a cause of severe hardship for others. The regulatory framework in place at the time had proved to be ineffective in constraining particularly high-risk lending and borrowing. The MMR package of reforms is aimed at ensuring the continued access to mortgages for the great majority of customers who can afford it, while preventing a return to the poor practices that we saw in the past. This module will be presented by Gemma Hall, Managing Director of Tenet Lime, and Mark Thomas, Tenet Head of Compliance Delivery. The module will aim to increase advisors' understanding of the purpose and impact of MMR, explain the changes that advisors will need to make to comply with the new rules within MMR, and explain the changes that lenders will be making and the potential impact these will have on the way advisors submit business.
It stands for the Mortgage Market Review and is a fundamental restructuring of how the mortgage market is going to operate in the UK. And it follows an extensive period of consultation by the regulator, to which we have contributed, before they brought out their final rules last year for implementation on the 26th of April 2014. The key aims of the MMR are to create a market that is sustainable for all market participants and create a flexible market that works better for the consumer. The changes introduced are also intended to address identified poor lending practices and reduce mortgage fraud. It reflects the fact that the FCA believes that acting in the consumer's best interest is a more appropriate standard to apply in the mortgage market than most suitable products. The MMR predominantly affects lenders, and in particular the removal of the non-advised sales process and the requirement that most interactive sales, such as face-to-face or telephone, are to be advised, and every seller has to hold a relevant mortgage qualification. However, there are still a number of changes to which advisors will have to adapt when it comes into force.
There are 5 key areas where the MMR is going to change advisor practice, and these are as follows: the requirements for advice, the change to and restriction in respect of execution only, sales standards, disclosure and affordability, and finally interest only. The overarching aim is to ensure that the process is transparent, that consumers understand what it is they are getting, and that lending is conducted in a responsible manner. You will find that all of the changes that have been implemented fall under one or more of those categories and support those regulatory objectives.
Lenders need to make sure that customers can afford the loans they apply for, both now and in the foreseeable future. This means that lenders will focus closely on affordability and look for evidence to support this. Your role as an advisor is to help them obtain this. Lenders have to apply a stress test to test affordability in the future, which essentially asks, if interest rates went up, would this still be affordable? They will be using a more prescriptive model to carry this out, and it can and will vary from lender to lender. However, as a minimum, the customer should be able to withstand at least a 1% increase to the rate they have applied for. Allied to this is an increased focus on interest only. In the past, interest only may have been used to make the mortgage repayments more affordable. So in those cases, therefore, they will be looking for a credible repayment strategy and evidence that this is plausible to the lender. And lenders may accept different things based on their own criteria. However, they will not accept anything of a speculative nature. Lenders must also have a responsible lending policy in place that captures all of these elements, and this policy will drive the lending criteria. This will also mean the end of fast-track mortgage applications, as lenders must be able to demonstrate to the regulator that they have validated any income information used in the affordability calculation.
This does not change the current requirements when you are providing advice, and particularly your responsibility to ensure that when recommending a mortgage you have established that it is affordable now and considered any foreseeable changes in income and outgoings. This also applies when the only suitable option is a product transfer. You still need to have discussed and evidenced the affordability of the loan. If you do need any clarification on the requirements for product transfers, please refer to the guidance we've provided in the Regulatory and Compliance Update last year. The main impact on you will be that because of the responsible lending policy, lenders will be looking for a high standard of documentation so that they can fully evidence how the consumer meets the affordability tests. What this means for your working practices is that you will need to ensure that you only proceed to decision in principle once you have all income evidence and verification of ID, such that you can test against the individual lender's requirements and criteria. The lenders will also be more challenging in respect of the plausibility of the information provided. So where you're submitting a case, where there are some things out of the ordinary, please make sure you provide an explanation to the lender and keep a note for your file. An example of this could be where the property is some distance away from where the customer's place of work is, or where the salary is exceptionally high for the type of employment. Because lenders' policies will change, you will need to work closely with them so you have a good knowledge of their requirements.
The regulator has said that advice must be given where there is spoken or other interactive dialogue during the sale. This means that it will no longer be possible to offer a non-advised process. And while some lenders will accept execution-only business, the additional limitations around execution-only means that many advisory firms, including Tenet, have decided that customers' interests may best be served by the provision of advice in all cases. Just talking in generic terms is not going to constitute advice, so as long as that conversation does not direct a customer to a particular course of action. So, for example, stating that generally lenders will allow a loan-to-income ratio of 2.5 times joint income is not advice. You must understand the customer's needs and objectives and make a recommendation that fulfills these. And you have to challenge what the customer wants and be prepared to ask why, as this will drive out a number of soft facts that will help support the suitability of your advice. For example, if the customer states he wants a 2-year fixed, ask him why. One example currently used by some of our advisors to check the customer's understanding is to get the customer to verbalise their understanding of the advisor's recommendation.
Well, you don't have to proceed with the sale. If you do proceed, you'll need to consider if an alternative product would be suitable to meet the customer's needs. It would always be worth, first of all, before doing additional work, checking whether or not the customer has fully understood your original recommendation, and make sure that you understand why this has been rejected.
There are a number of strands to the sales standards expected. Firms must always act in the best interest of their customers. The intermediary must assess that the customer meets the lender's eligibility criteria. There is a strong obligation to consider appropriateness, and clear disclosures must be made to the customer before work commences. And there must be a positive election by the customer to add fees or charges to the loan amount. It is important to recognise that if you hold yourself out as independent, you still have to offer a fee-only option. It will be important to verbally describe clearly the range of service you will offer to your customer. For example, we offer a comprehensive range of mortgages from across the market, but not direct deals that you could obtain by going direct to a lender. MMR has recognised that customers in this market pay attention to what they are told more than to what is written down. It is therefore vital to clearly describe the services you offer when you speak to your customer and how you will be paid. You will need to train this into your staff, perhaps as part of their induction to the firm and part of the supervision from a monitoring and supervision perspective. However, the oral disclosure you are required to provide is also supported by written documentation so that the record of the sale is as complete as possible. As a result, we've decided to retain the IDD as a network requirement. But because it is no longer a regulatory requirement, the key facts logo will need to be removed, along with the statement that it is a regulatory requirement to be given out. This will affect mortgage-only and equity release-only IDDs, as it still remains a regulatory requirement for a combined IDD which cover the sale of insurance as well as the mortgage. However, further small changes to the home finance section appear now to be needed to these as well. The IDD is a way to support you in providing a description in a clear and fair and not misleading way. The trigger points for the issue of the KFI have also changed, although the information will remain the same, at least for the time being, as the EU may ultimately change this. And the trigger points are: before the customer submits an application, or at the point when advice is given, when they ask for one, or for directly authorised advisors who may decide to do execution only, it should be issued when they know the product. The bits you need to focus on are making sure you clearly describe any limitations to the products you will be offering, how you will be paid, and if your practice has been to routinely add arrangement fees onto the loan, you will need to amend your process, as you will need to be able to demonstrate the customer has positively elected to do this. You can tell them they have the option of adding the fee, but you should not steer them to taking that up. This is an area that the regulator may be interested in, and specifically the volumes going through this route. So to protect you, we've provided you with a way of capturing the customer's consent. The key to this is that if the fees are added to the loan, interest is added, increasing the costs. And the lender will also be requesting your confirmation that the customer has consented to any fees being added, and may also ask for evidence of that consent. And in the case of a joint mortgage, both customers must elect. Where a remortgage is being considered, the customer needs also to be aware that a further advance from their existing lender may be available. However, you are not obliged to prove that the further advance may be better than a remortgage.
Whilst interest-only mortgages have not been banned, the FCA considers these to be niche, and their availability has become more constrained as a result of this, and by concerns from the lenders about the ability of interest-only customers to repay the loan. There are no material changes being implemented under MMR for interest-only mortgages, but a credible repayment strategy is required. By credible, we mean that it must not be speculative. For example, no lender would accept a repayment strategy linked to an expected inheritance. Even where the repayment is by downsizing, some lenders will have a minimum valuation below which they will not accept that method as being credible. So, for smaller properties outside of the hotspots, such as London, this could be an issue. There is a requirement on the lender to periodically check with the borrower that the plan remains in place, but they will have to first accept the strategy. You are not required to assess the repayment strategy or to advise upon it, but you should consider the lender's criteria and whether or not the customer's proposed strategy is likely to be within it. So, if for example the customer stated that they had a pension that would produce tax-free cash sufficient to repay this, the advisor should check that it is a strategy the lender would accept, and then ensure that the customer has the documentation to evidence that it exists. The advisor could go so far as to ask the customer to obtain a projection from their provider in support of the application.
Mortgage fraud is a crime in which the intent is to provide false, misleading, or omit information on applying for a mortgage to gain a dishonest advantage or financial benefit. This can be done by false representation, failure to disclose information, or abuse of position. You must not process an application where you know, suspect, or given the circumstances of the case, should suspect that the information is invalid or incorrect. And if you suspect fraud, please in the first instance refer to the Compliance Department for guidance. The biggest source of fraudulent applications is business introduced by a third party. So if you obtain leads from introducers, you need to make sure you know the introducer, as they could have previously been restricted from providing advice due to removal by a lender, network, or even the regulator. So always vet your introducers, meet them in person, and carry out your own checks, such as online ID verification. Always get a full understanding of where the leads are coming from, and also find out who else they introduced to. And be aware if the introducer is providing all the documentation, as it could be he's arranging false documentation for the client. Also, do not allow the introducer to answer for the client, and do not allow the introducer to be overly involved with the sales process, as advisors should be wary if the introducer has an interest in the client attaining the mortgage, such as the client is purchasing property owned by the introducer or the client even works for the introducer. Another area to be aware of is identification fraud. And this is where someone obtains credit using someone else's details. So you need to ensure you do full identification checks. And we would encourage you to use an online ID verification tool. This is far more robust than manually checking the documents, as quite often fraudulent documents are of such a high standard they are difficult to spot. Now, the most frequent type of fraud is false occupation and income details, or inflated income. So you must check that your client's income and details are plausible, accurate and consistent with their circumstances, and consistent with the other documentation. Check the national insurance number, employer's address, tax code, income and commission, bonuses and the accounts. Do not round up the client's income figure, as this will be viewed as inflating their income. And retain evidence of the client's income even if the lender does not request it. You can also check on Google and Google Street View to confirm if the employer and company exist, and also contact them to inquire if the client works there. Be wary of PO box addresses and ask for the physical location where the client works. For self-employed, make sure the SA 302 matches their accounts, and any rental income received should also be declared on the SA 302. Remember, some lenders are able to check with HMRC. You can also check out the accountant's details, such as do they have their own website, or telephone the accountant to confirm that they actually exist. Remember, it is unusual for a client to earn the same amount each month, and the bonuses to be exactly the same each month. There are usually several deductions from the salary, especially for high earners. And you should also check that the salary is paid by BACS and request the corresponding bank statements. Check the BACS code on the payslip matches that on the bank statement. Check the page numbers of the bank statements are concurrent. Don't forget to check the bank statement to ensure that all outgoings on the statement match those disclosed in the fact find, or query if there is another bank account with further outgoings where funds are being transferred into this bank account. Also, outgoings should be commensurate with lifestyle and size of family. Again, this information should all be plausible, and this will be something lenders will check closely because of their responsibility in respect of affordability. Now, scheme manipulation is when you're submitting a residential mortgage as a buy-to-let or vice versa, and this has become more prevalent. And if you are even unknowingly involved in this, the lender will take serious action. And in most cases, this will be removal from their panel. And panel removals are notified to the network and the FCA. And this is often then followed up by an investigation and can result in suspension or termination of the advisor's authorisation, and in some cases of the AR. You will need to be alert to any indicators that the customer may not be planning to rent the property out, such as an insistence on interest only, and that they are unable to prove income, even if it is not a requirement by the lender. And also be aware of the indicators in relation to customers who are applying for a residential mortgage but are not actually going to live in the property, such as they already have a buy-to-let portfolio, or the type of property does not fit their lifestyle, or may not be located near their place of work. Now, this is not an exhaustive list, but if you are extremely vigilant and keep impeccable records of the checks you make, then you will be able to demonstrate that you have not knowingly been involved in any potential fraudulent activity.
We hope that you found this session useful and now have an increased understanding of the purpose and impact of MMR, can explain the changes that advisors will need to make to comply with the new rules within MMR, and can explain the changes that lenders will be making and the potential impact these will have on the way advisors submit business. As we progress towards the deadline and beyond, Tenet will continue to support advisors through these changes. Thanks for watching.